Thanks very much, and thanks to the organizers for including our paper. And as you can see, this is co-authored with some very talented researchers that I'm very proud to be associated with. What we're focused on today is something that has gotten relatively limited amounts of emphasis up to now. But obviously, the board of directors is very critical to protecting shareholder interests. They've got a lot of power. And not surprisingly, large non-controlling shareholders typically will try and influence the firm through the board. And since 2003, we know that in the US at least, a majority, if not a large majority, of the board is made up of independent directors. And that the major committees of the board have to be completely populated with these same directors. And so we're going to focus primarily on that subgroup of the board. Now, recent evidence shows that independent directors are primary monitors of managers, but that their effectiveness really varies significantly across different firms. And also, one of the potential reasons for that is that the level of incentives that directors have, independent directors have, seems to be of limited influence. They have financial incentives as in terms of annual compensation. They sometimes have significant shareholder interest holdings, but usually not. The effectiveness of the labor market for directors, if they don't perform well, shows some degree of discipline or penalties, but the level, it's not clear, is enough to deter poor performance. And in addition, independent directors who are on multiple boards have varying levels of reputation incentives across those different firms. So now the key questions we're going to ask are, one, how do institutional shareholders influence the board and its independent directors? And two, does active shareholder monitoring on the board significantly improve firm performance? And one of the key challenges to addressing this type of a question is the fact that there's obviously a major endogeneity issue associated with changes in ownership structure of major holders of shares in the firm. So we're going to try and avoid that problem. So the basic question, research question we're going to address is, does institutional investor attention improve board monitoring incentives and thus their effectiveness? And as we know, institutional investors often hold large positions, investment positions, and they also have a fair amount of expertise and information access that should allow for more effective monitoring than for a typical shareholder. And several recent studies have also indicated or uncovered a fair amount of evidence that in general they help to improve corporate governance and thus value. But the question is, through what channel do shareholders improve firm performance? And the existing evidence, as you know, tends to emphasize rather dramatic events, various types of shareholder activism, proxy fights, challenges, lawsuits, and other types of aggressive activity. But those tend to be relatively rare events, and they tend to be for a small sample of firms that tend to have long-term problems. Yet, it's our perspective that there's a clear need for ongoing monitoring of the board by outside shareholders, and in particular institutional investors who have large positions. The main hypotheses we're going to look at are one, it's unclear if independent directors have sufficient incentives to perform well without shareholder monitoring. And these institutional investors clearly have some fairly significant incentives to want to actively monitor, given their large positions and their potential exposure to moral hazard problems. Maybe one exception to that would be possibly index funds. Now, institutional investors improve monitoring incentives using various mechanisms. One of the most important that we'll look at is voting on directors in annual meetings. But they can also initiate proposals regarding things like governance at annual meetings. They can participate in conference calls. They can privately talk with the board or with senior management. So they've got a variety of levers. We're going to primarily focus directly on the voting lever. Now, our strategy in dealing with the endogeneity problem is to follow a recent paper by Kempt, Manconi, and Spelt that's in the RFS. And what they do is they use unrelated industry shocks to an institution's portfolio as a source of exogenous variation in the actual level of monitoring by that institution. And for each industry quarter, we're going to define the shock as being the Fama French industry sector that has either the largest or the smallest return in that quarter. And that's going to exclude the industry that the focal firm is in that we're looking at. And the idea here is the extent to which there's a shock in one of these other industry sectors is going to shift the attention of the institutional investor. And what we want to do is capture the effect of that loss of attention. Now, the underlying assumption of this is that these institutional investors have limited amounts of attention, and they tend to allocate these to situations where the sectors are doing particularly well or particularly poorly. That can be justified in terms of rational explanations or by behavioral explanations. And to locate these large distractions for a particular institutional investor, we're going to adjust each industry shock by the investor's portfolio exposure to that particular sector, which is at the investor level. And we're going to then aggregate that across all the institutional investors to a particular focal firm. And then we're going to adjust that for the importance of that investor in the focal firm in terms of the ownership position that they have. And I'll talk a little bit more about that in a second. So for each institutional investor focal firm pair, we're going to aggregate the return shocks to the investor's portfolio sectors weighted by the fraction of the investor's portfolio that's in that shocked sector. And then we're going to average it for each of the past 4 quarters. And then we're going to aggregate all of the different institutional investors, investor-level distractions, to obtain an overall focal firm aggregate total investor distraction measure. And we're going to adjust that for the institutional investor's importance to the focal firm. Now, how do we measure that importance? Well, we proxy that importance by first sorting institutions' ownership percentages in the focal firm, and then we also look at the focal firm's weight in the investor's portfolio. So we have the same total investment. In one case, that equity investment is scaled by the total assets, total shares of the firm, or total equity value of the firm. In the other case, the other weight is scaling by the total portfolio value of that investor. And then we're going to sum those two percentages and create a scaled weight that sums to 1. And thus our investor distraction measure is going to capture the extent to which there is a major institutional investor shift in attention. Now, the main results that we have are that we find institutional distractions weaken board governance. They lead to weaker board oversight. The investors are less likely to vote negatively to discipline independent directors, and those directors are less likely to leave when they get poor voting outcomes. As a response to lower investor attention, the board monitoring intensity of the management also falls. We find that the number of independent directors missing at least 25% of meetings goes up. We find that the number of meetings by the board goes down. And we find that distracted institutional investors are also associated with poor board composition and monitoring quality. And we measure that by the number of weak independent directors that are appointed in that period, and by whether the boards approve excess CO pay and allow for greater earnings management activity. And ultimately, we look at the effect on firm value measured by Tobin's Q. Now, to get into the details, we first look at individual fund level voting patterns on individual directors, and we examine the effect of that particular fund being distracted. And we're going to measure either a no vote or an absent vote as a negative vote. And the main explanatory variable is going to be the distraction level for that particular investor. And we're going to use a typical set of fixed effects, fund year fixed effects, and election proposal fixed effects. The results that we find, I think, are quite interesting. Overall, we find that the amount of negative votes that are received by independent directors significantly falls. And more interestingly, the number of negative votes for problematic directors, who we define as either very busy directors or directors who have social connections to the CEO. Both of those also fall even more dramatically. Economically, a 1 standard deviation rise in institutional investor distraction reduces the chance of opposing a problematic independent director by about 7.5%. And we find the most significant effect for these problematic director candidates. We also find that if we exclude the 6 largest fund families from our data set, that the results stay very similar. And so if one was worried that they would be less likely to be distracted because of larger staffs, that doesn't seem to be the case. Overall, we provide, I think, some very interesting investor-level evidence of behavioral change around these distractions. and that they are less likely to vote negatively or discipline directors. I might note that there's several other consistent pieces of evidence that were also uncovered by Kemp that also suggest that these institutional investors' behavior changes in terms of their reduced participation in conference calls and in terms of initiating fewer corporate governance proposals at annual meetings. The next thing we do is we aggregate up those individual investor distractions to look at the total set of institutional investors in the individual firm, focal firm. We'll call this the total distraction that's being experienced. And again, we're going to look at what's the effect on the number of negative votes for directors. And what we find is consistent evidence at this more aggregate level of the firm that says that total distractions, again, significantly lower the negative votes that directors receive, and especially those received by problematic directors. The next piece of evidence that we explore is, well, okay, if you get negative vote outcome, does that increase your likelihood of exiting from the firm? And is that equally true if the institutional investors are distracted? And so we're going to look at, as a dependent variable, whether the director departs in the next several years. And the key explanatory variables are obviously the total distractions, and that variable interacted with either the fraction of no votes or a poor director voting outcome indicator. And then we look at also poor attendance and major committee memberships. What we find is that when you focus on the interaction, well, first, there's not much for total distraction by itself, but when you interact it with no votes, what you find is that there's a significant negative effect that offsets the likelihood of turnover given no votes, which you'll also note increases the likelihood of turnover by itself. And then we get a similar result when we use the indicator variable. The next thing we do is look at monitoring activity in a couple of dimensions. We want to look at the likelihood of nominations of problematic directors, either new problematic directors or renewals of existing directors. And we're going to also look at various measures of monitoring efforts in terms of frequency of missing board meetings and in terms of boards having fewer meetings. So in terms of institutional investor distractions per se, what we find is that with more distractions, what we find is there's a significant increase in directors missing more, or more directors missing board meetings. But more importantly, we find that that result is even stronger for the problematic directors. And part of that is probably because they tend to be busier. The other thing that we do is we look at the actual board meeting frequency. And what we find there is that, again, there is a reduction in the number of board meetings for the year when there's more distractions of these institutional investors. And then if we interact, and if we also look at whether there's a poor Tobin's Q for the prior period, which ought to increase the number of board meetings, we find that it does. But then when we interact that with the distraction, we find that there is a negative effect. We then look at the board composition and look at the likelihood of getting new problematic independent directors. And what we find is that in terms of new appointments, that there's a significant increase in the likelihood that they will be problematic. If we look at reappointments, we also find that there is a significant increase in the likelihood that they will be reappointed, and that result is even stronger if there are some problematic independent directors on the nominating committee. In terms of investor distractions on board effectiveness, we look at earnings management, we look at high excess CEO pay, and then we look at firm valuation. And what we find for earnings management is that it significantly rises using accruals measures. We find that in terms of high excess CEO pay, that it's significantly higher. That is exacerbated if there is if the proportion of problematic independent directors on the compensation committee is larger. And we find that the Tobin's Q is significantly lower. And that's especially true as the proportion of problematic independent directors rises. So in conclusion, we examine how monitoring by institutions influence board governance following the Kemp study. And our major findings are that institutional shareholder distractions significantly weaken board oversight, leading to weaker board monitoring and incentives and poorer board monitoring quality. No votes at director elections go down, especially for problematic directors. And exits of those directors go down as well. This also appears to lead to more independent directors missing board meetings, and there being fewer board meetings that year. And then finally, there's higher earnings management, higher CEO excess compensation, and lower Tobin's Q. So I think our evidence indicates the importance of institutional monitoring on a regular basis. Thanks.
I think those of you who have heard me speak so far know that I'm not an academic. I am a practitioner. So I'm going to rely very heavily on you to do the analysis of the data sets and the regression and so on, because that's so totally out of my area of expertise. It's not funny. But what I did want to do is give some reflections from the practitioner point of view. Now, some of what I'm likely to say doesn't really read across to this study because I work for a firm that is predominantly index strategy based. And as far as I understand it, the paper is focused on US investors that have only active managed strategies. So that is a totally, it's a different lens through which investors might look at their portfolios and through which they might exercise the accountability mechanism with boards and management.
Let me give you one caveat. We only exclude the index funds for the first table.
For the first table. Okay, yeah. So thank you for that.
So it's more relevant, I think.
Brilliant. So just a little bit of additional context on how, in my experience, investors engage with companies, particularly where they have concerns about governance. Generally, they're looking at those companies where they think they can affect change. And so the study excludes controlled companies and so on. I think that makes perfect sense. But the area that we tend to focus on is trying to build mutual understanding. Where we have concerns about management performance or financial performance, we tend to focus on engaging with management rather than the board, especially in the first instance. If the performance is poor over a period of time, that is when we would look for the board to have done something about it. And I think in that sense, we might be sort of behaving a little differently to how the study might suggest investors behave. In our analysis of the companies to focus on, we look at financial performance generally over a 1 and 3 year period and sort of underpinned by a 5-year period. We look at their governance structures. Do these align with our policies and our expectations of good governance? We certainly would engage either management or a board if there's been a significant operating event, and that could be a major product recall. It could be something across a sector, like a crisis like the opioid crisis in the pharmaceutical industry. But we're again, probably going to start with management. And then the other reason we meet with companies is when the company asks to meet with us, because they want our feedback as a major investor. In doing that filtering, we use both data and third-party research. So the data to filter on the performance criteria and the governance criteria, some of along the lines that we discussed earlier around the Sustainalytics type data on the E and S dimensions. And then the third-party research to flesh out some of those characteristics of the company that might be a focus for that conversation. So that can be investment bank research, or it can be proxy advisory research. And it's after the conversation where we've asked questions, we've explained our thoughts and our reaction, our concerns, we give companies time to respond. And so in that sense, where we have concerns, we're very unlikely to vote against management, which includes voting against director elections, in the first shareholder meeting after something has gone wrong or after we've expressed our concerns about the way the company is governed. Because certainly our philosophy is, unless there is something happening that is very clearly detrimental to near-term shareholder value, we need to give companies time to respond. And if you're expecting companies to change, fundamental change in business practice, in governance, in operating thinking, that takes time. You can get cosmetic change quickly, but fundamental change takes time. Those conversations we have are private. And I really empathize with academics who are trying to draw out where it is that investors are influencing companies' thinking, may have had some impact either through accountability or through conversation on the behavior, on the approach that the company takes. But the purpose of having those conversations being private is that we can then be quite free and frank. Because I can tell you, companies are very reticent in talking with their investors if they think the nature of that conversation and certainly the content of that conversation is going to end up in the business pages the next day. And so we see real importance in having a free and frank private conversation, particularly where we think something's going wrong. So I found the paper really, really interesting, not least because it basically endorses everything that my team does, and so I expect to have a job for a long time. And on a serious point, that there really is a responsibility on investors to monitor the companies that they are investing in on behalf of their clients, in our case, and provide feedback to those companies. And that generally, when investors do that, they respond, they behave differently. And I think that is a strong endorsement on that engagement model that comes with corporate governance as we know it here. There are a couple of things I have, and maybe it's a misunderstanding, maybe it's a language thing that I wanted to raise. Because one of the key points, it was one of your opening bullets, and it's one of the first sentences in the paper, is that a principal role of the board is to be a gatekeeper of shareholder proposals. We would certainly put that a totally different way around. In our view, the principal responsibility of the job is to ensure the right people are in management and they're doing a good job. And so that's the oversight and then the counseling part of it, because in our view, the value add, the competitive advantage of a board is that they have collectively and individually as directors insights and experience that they can use to counsel management to deliver long-term strategy and to have and achieve operational excellence. And so the way that we think about governance is about leadership. The other very important job they have, in our view, and this is where a lot of boards fall incredibly short, is hiring and firing the CEO. And it's on the latter part that they fall short. They wait too long. And this isn't necessarily something directly relevant to the paper, but I think it's a really important responsibility of boards, and one that I think we need to explore a bit more, just generally as a what is the trigger that makes directors take action on something that is really difficult and is going to involve a lot of their time if they go ahead with it. And we also see boards playing a very important role as a communication channel, when communication with management about areas of concern, particularly about long-term performance and delivery of strategy, seem to have fallen on deaf ears, where there's no response from management. That is when we depend very heavily on the board to step in and push for management to respond, or to tell us why we're wrong. Because that's a legitimate response of management as well. But often they hear the feedback and then they go quiet. So what I've been trying to say here is that we engage with management and boards for different reasons. And if I've understood what the shock analysis is, the distinction is, and I may not have, where the company has had a shock, we would be engaging with the management first and foremost. And equally, we engage with management when nothing has gone wrong if it's an active holding. And I would think that a lot of active managers in the study would continually have dialogue absent a shock. A couple of other questions I had about the way that you define some of the measurements. So in our experience, shareholder attention is not really measured by attending conference calls. I don't really understand the choice of that measure as a sign of shareholder retention. And it is certainly not how many shareholder proposals you put forward. I mean, it's a tiny cadre of shareholders, institutional investors, who use shareholder proposals. Tiny cadre. And it tends to be a small number who do a lot of them, rather than this being a very widespread tool that institutional investors use as an accountability mechanism. And so, again, it could be I haven't understood why you use those measures, but those are questions I have for you. Another definitional question is around problematic directors. And I would really like to understand better why you chose 3 boards, because I don't know a single institutional investor who has in their voting policy that a director being on 3 boards is a busy director. We have one of the most aggressive policies in people's minds if you're a board director, and that is we limit that to 4 unless you're a sitting CEO. And if you're a CEO of a public company, you can only be on 1 board outside the company of which you're CEO. And that is around the time constraint and the focus. But certainly for the whole period of your study, ISS, which is a major influencer in this area, had 5 directorships as the maximum. And so I think it'd be interesting to understand why you chose 3 and how that might change, how the outcomes might change if you reflected the de facto policy in the market at being 5 at the time of the data set. The other question I have is around the use of BoardX for identifying problematic directors. I haven't seen BoardX in recent times, but certainly in the period that the study covers, my memory of BoardX is basically it identified practically any connection directors might have had with one another. So, any graduate at Harvard was identified as somehow being connected, but remotely, with another graduate of Harvard, particularly if they were in a same maybe 5 or 10 year period. I don't remember the details, but all I'm asking is, are you certain that BoardX is a good measure of how closely tied a director might be to the CEO, and therefore how unobjective they might be? Then the other question I had was around size bias. in the set, and I couldn't find any information. That could be because I'm not an econometrician, but it was around the companies in the universe studied and whether there is a size bias there in some of these outcomes, in part because smaller companies tend to have fewer board meetings, period, absent any events or any sort of situations. And the number of board meetings can also depend on other factors like the complexity of the business, the global reach of the business, regulatory requirements if you're a regulated entity because you need to fit in so many board meetings to go through your board schedule and so on. And then the other thing is that widely held smaller companies do tend to get less investor attention. Widely held smaller companies do tend to get less attention from investors because they have less value at risk, as a general comment. And so, it is kind of a natural bias towards large cap in terms of where you focus because it's where your clients have the most value at risk. And frankly, where you're most likely to have an impact. Because I think the other thing that would be really interesting to flesh out from the analysis is if there is a sort of clear small cap segment, in that segment is that, that trend you identified of directors who don't get majority support or who get a significant vote against staying on. Because that's certainly what I see in practice. Any company that thinks it's going to be in the Wall Street Journal and their director doesn't get majority support, that person's gone by the end of the shareholder meeting. Anybody in the smaller cap of the sector where they can say, yeah, but the investors didn't really understand what they were doing, or so on and so on, those directors have actually managed to stay on, particularly in US, where I think most of you know, it isn't a majority vote standard in law, it's by practice and by law, as opposed to an established standard. And certainly over the period, the majority of the years in this study's time frame, even a voluntary mandatory re-election standard was not widely observed. The other thing I think is interesting about the time period, particularly in relation to how to read this forward, is since the financial crisis, pretty much all institutional investors have beefed up what they do on corporate governance. So they've enhanced the number of people in their team. They've often published policies that then help companies understand investor expectations and often are more willing to vote against where they see repeat offenders, if you will, simply because they've got a better understanding of the importance of the role they play in being a check and balance on companies, and particularly on management and boards. So to give you a sense of that, when I joined BlackRock in 2009, we had 16 members on the team. We're now at 32. And as Matt said yesterday, we're more than doubling up to 70, 75 by 2020. And we're not alone in that. We're the biggest, so we have the biggest team, but there are many others who are doing more of this. And increasingly in the last 5 years, you're also seeing more portfolio managers, active managers, really trying to understand how to use the accountability mechanisms you have as a shareholder in a way that is different than they might have before. Anecdotally, a lot of active shops historically really did believe in the Wall Street walk, and they often didn't participate in shareholder meetings. And I don't know how that plays out in the data set, or if they did participate, they relied very heavily on either ISS or an in-house team that was divorced from the asset management team. And that is changing as well. There's a lot more integration now, so it'll be interesting to see how that changes going forward. Oh, that was the other thing. I was trying to read my handwriting. The sort of close to final point is the lags in the accountability. And I did mention this before. When we see issues, we generally meet with companies, talk to them, and give them time. I'm just wondering whether the patterns hold out if you did this, not the 4 quarters up to the shareholder meeting, but the 8 quarters up to the second shareholder meeting after the shock and see if the same thing holds out, because there often are lags in governance world in my experience. Yes, I mentioned that. The other thing that's in the paper that didn't really come out in the presentation is that you say that actively managed firms are more likely to gain from active intervention. And I'd like to understand where that thinking comes from, because certainly the rationale of a lot of index investors having teams like mine is they think there's a lot of benefit to their clients of improving beta through engagement and through active monitoring of companies. So it'd be good to understand that a bit better. You also say in the paper, and not in the presentation, that you excluded the 6 largest fund families because they're likely to provide pension services and may not act as independently. And I think that is something that is widely perceived, and certainly studies I have seen have not demonstrated it. There was a study on BlackRock's voting on climate risk disclosures, on shareholder proposals, and where a company, a corporate entity that had one of those proposals was a public company. We voted against 8%, and where that public company was also a client, we voted against management 8%. And so I think it could be that there's something there, but it could just be that it's anecdotal. And then there are a couple of points that I just frankly didn't understand, and that's probably me as much as anything, because it may be that you all got it. You say on page 20 that there's a stronger distraction effect for mutual funds that are affiliated with institutions more likely to monitor, such as investment companies, independent investment advisors, public pension funds, compared to other funds. And I just didn't really understand what that affiliation was and why that would make a difference in the monitoring effectiveness. And equally, one of the most fascinating things from my point of view, given this is something that we really promote, the study says that director ownership of shares in the company is less of a driver of good behavior, if you will, than shareholder oversight. And that's kind of shocking, because all the investors are saying board members should have a significant financial exposure, personal financial exposure to the company, and maybe we're barking up the wrong tree. But those are my observations, so thank you very much.
Let me just take just a couple of quick comments, just to clarify a couple of things, and then I'll make it, open it up. Let me first say I want to thank my discussant for lots of thoughtful and intriguing observations that we'll try and pursue. Just as clarification, the discussion on shareholder proposals and conference calls, that was not our evidence. That was evidence in the prior study by Kemp. Also, the shock that we are looking at is not in the firms, in the focal firm, and it's not in the focal firm's industry. It's in some other industry, therefore exogenous. That's important. And that's why I think the lag issue probably, or looking further into the future, is less of a concern. And then finally, you were asking about the academic research, asking about why 3 independent directorships being problematic. And I think that really reflects the existing literature, academic literature, that seems to focus on finding that that's a level at which things seem to be somewhat problematic. Okay, and I think I'm going to stop there and open it up.
So this is almost a question for one of the major investors, whether it be BlackRock or somebody else. We don't know what engagement adds value and what engagement doesn't add value. You don't really know either. There's probably any number of people in this room that could help you design a good randomized trial to try to actually learn something about that, given the number of companies in your portfolio. It would be really lovely if one of the major institutions actually took that idea seriously, and we might learn a lot.
This is a question for the discussant, actually. One of the things I was really curious about is there's this really, I think, intuitive and nice measure, but I really, this shock, and I'm really curious to know what is happening on the ground. I mean, how does the resource reallocation happen? What does it look like when an industry has a shock and you have a team of 30 people? How do you think about allocating who does what in those circumstances? In other words, to what extent is there construct validity for this measure?
So I'll try and make it quite tangible. So for the Americas, we divide our team by sector. So they are all sector analysts in the sense, and that's to align those individuals with the portfolio managers who are also divided up by sector. And the importance of that is it could be, I can't see one of our analysts being distracted unless they happen to have the very bad luck of having two of their sectors getting distracted. So, that there's, having an event, because if there's an event in the pharmaceutical sector, for instance, that doesn't necessarily take attention away from the telecom sector because that person is a different person monitoring telecoms. So in that sense, that doesn't really play across for the way our team is structured. I also think in some ways, an individual asset managers, it's less about sectoral basis because the portfolio managers monitoring companies are monitoring the companies in their portfolio. So it's not at the firm-wide level that monitoring is done, it's at the portfolio level. And so I think in that sense, saying because companies in that sector have had a shock, that a portfolio manager here who doesn't even invest in that sector is going to be distracted from their companies is a bit of a reach. But again, I don't know how that aggregates up in a whole universe of investments and companies.
And I assume as you go to smaller investment organizations, there's probably less specialization.
Okay, well, thank you. And your result was very interesting. But I thought, I was not so convinced by your kind of definition of distraction, the way that investors are distracted. Because, you say that when some industries have best return and worst return, then investors would be distracted by those industries, and companies in other industries would get less attention. Mm-hmm. Well, if like for portfolio managers who are like deciding whether to buy or not sell, they might be distracted. But my takeaway from the discussant was that, engagement or voting no would be done when things are going bad. So I could not get why investors would be distracted in terms of engagement when some other industries are having best return. So,
okay.
Yeah. So and maybe your assumption is that so people who are deciding whether to buy or sell and people who are deciding how to engage and how to vote is the same one. But I'm not sure whether this is the case in every fund.
Okay. I think that's reasonable skepticism. I will note that we did robustness where we broke it up into just negative shocks and then positive shocks, and we found we got very similar results with both of those. So that may give you some additional comfort. But I think the other, points I would make would be one, for smaller organizations, I think there's less specialization, so there's more likely to be more of this attention distraction going on. And when we knock out the largest fund families, we get the same or stronger results. Okay, so and I think it's hard to explain why suddenly the different it's hard for me to understand why votes on directors would change when there's this type of exogenous shock otherwise.
On the questions that other people have commented, namely, when are people expected to be distracted? So I have the same concerns about whether this shock to part of the portfolio is going to be such a good sign. One, because in most social investors, we do have a proxy voting department, which sometimes is very small, but it's separate. Secondly, if you have a shock to the portfolio, that's not what most matters to people, if you think about distraction at the level of the whole organization, because for most of them, what matters is how they are doing compared with their rivals. So that would actually matter to them most. So the shock might be their performance relative to others. And then maybe even better might be to look at the flows out, which we were talking about. There's nothing that would get their attention or would make them distracted. If they are losing a lot of money in the preceding quarter, in the corridors they'll be talking about that. Or, and I know that some finance papers do that, you can look at things like, that's an unfortunate thing to mention, death at the top of the organization. And lastly, I think that quite a few of the smaller funds or even fund family, sometimes they just have 1 or 2 or 3 people. So there's like a massive, when they lose a person or when they add a person, it's like a massive increase in capacity. And you can probably identify kind of a number of instances in which the proxy department doubled or was halved. And you can see whether that can generate any results.
Okay, I think those are some interesting additional suggestions to either use as robustness or as an alternative shock.
Here. On your left?
Okay,
okay.
Sorry.
Here. So first one clarifying question and then the actual question. When you count support, are you counting shares voted by mutual funds or simply noses across mutual funds? Do you simply look at the NPX form? Is that what you're doing?
Yeah, we're looking at the actual no votes by these mutual funds.
Right, but how many shares they voted no or how many funds voted for or against?
How many funds?
Okay, so this leads to the next question then, which is there will be many funds, particularly among the small funds that you tend to focus on most pervasively, that simply mechanically follow ISS. So this could provide either a potential placebo test. So if you mechanically follow ISS, and maybe we can assume ISS will not be subject to this same kind of distraction, then you shouldn't find the result if you only focus on the subset of funds that you can identify as always mechanically following ISS.
Okay, we do control for ISS recommendations.
But this is not the same thing I'm suggesting.
Okay.
And the alternative could be, well, maybe ISS itself could be subject to distraction. ISS is also lobbied intensively by different types of firms, so perhaps their attention span is also strained.
Okay, thanks. There are changes in their, before and around the period of the acquisition, whether there's any change in, how critical they are.
Okay, that's a good suggestion.
Yeah, I actually had a similar question. I guess Morton Bennetson started this distraction business with, somebody in the CEO's vicinity dying, and the stylized fact was when the spouse dies, they get distracted, and when the mother-in-law dies, they don't. So I think this distraction identification is interesting.
Marco, could you just make the mic
I think this
closer?
distraction instrument idea or identification idea is interesting, but I guess the question is how distracted do they really get? And ISS, I guess, really don't get distracted. So we know that some vote robotically with ISS and others don't. So I think that will be a really good idea to see whether they do get distracted or not. And then there's, of course, the question how much influence shareholders have on M&A in the US to start with as compared to the UK. But that's another debate.
Okay, thanks. Sounds like a separate study to me, but interesting one.
Okay. Ron, thank you.
Thanks.